Yeah, professional student, you are welcome to another session under derivative valuation and analysis. And in this session, we want to look at forward contracts and how it could be valued. So, forward contracts are basic derivatives that are used by both international companies and financial institutions to hedge risk and focus on future transactions. Calculation of value of forward contracts is also discussed in this lesson. We try our best to do that. Now, what are forward contracts? Let's start from that side. Forward contracts are a form of a derivative. Before we go to that, when we are talking of forward contract, you will see that derivatives are very complex financial instruments available to investors. So, investors take buy or sell position on assets or financial instruments they don't own, betting on the movement in the price and the underlying assets. Now, if that is the case, and this contract that is being used in the market to take that steps, that is forward contract, is a derivative. That is a form of derivative is a forward contract, and a forward contract differs from most derivatives in that it is entered into between two parties to sell or buy certain amount of commodity. That is, a forward contract is differ from most of derivatives because it is entered into between two parties to sell or buy certain amount of commodity, currency, or financial asset at some future date for a set price. So the intent of the forward contract is to lock in, please note it, is to do what? To lock in a price of the asset for the benefit of both parties, or one party might be willing to take a risk and on the final spot or market price. So the market for forward contracts is highly unregulated and it is considered as the over-the-counter market. Since the transaction is between two parties, the size of the market is unknown but is estimated to be huge because international companies and financial instruments, that is international, let me come again. I said the size of the market is unknown but it is estimated to be very, very huge because international companies and financial institutions use forward contract daily to hedge the currency and interest rate risk. So this contract we are saying, that is forward contract, can be tailored as very complex financial instruments. It can be tailored as a very complex financial instrument. So the breadth and the depth of these contracts expand when any types of financial instrument such as stock, bond, treasury, interest rate, and so on and so forth can be used in forward contract. So that is about forward contract, what it means. Now, let's try to see the difference between this and the future, although we have not talked about the future, and we are talking about the futures contract. Futures contract is a contract that is, anyway, we said future contract when they are discussing the derivative market. Future contract is another market where the activities there are highly standardized. Understand? We are talking about the similarity of these contracts. Both the contracts involve an agreement to buy or sell commodity at some price in future. So investors in both are speculating on the price of that commodity at future what? At future date. So at the future date they are thinking the price will favor them or not. And the price of this contract at initiation is zero. However, the future contracts trade on exchange, as I said earlier, and the future contract profit and loss settlement on a daily basis based on the trade price. There are futures contracts available for most of the major commodities such as corn, wheat, orange, and so on and so forth. Investors in future contracts are taking long or short position on the price of commodity, betting on the price movement on the commodity over the time. Now, let's now look at how these contracts are being valued. That is calculation of forward contract. when we are talking of a forward contract as stated is a contract between two parties for sales or delivery of fixed amount of commodity or asset at a future date for a set price which is agreed now. So the value of contract is set and the transaction is settled between the two parties. So the value of the contract at initiation is what? Is 0. The value of forward contract at initiation in the beginning is 0, but none of the parties deposit anything. It is gentleman agreement which is expected to be obliged at the end of the contract. So the contract has no value until contract is terminated or one party chooses to settle the order. And since it is not traded on any exchange, it has no value to either party when it is initiated. So let's look at this example in order to see how it is being valued. Now, we have Growing Incorporation selling a forward contract or sells a forward contract to sell 2 million bushels of corn to Financial LL at $4.30 per bushel on September 5. So the value of that bushel or of that contract at settlement is what? Is 8.6 million. How is it 8.6 million? What we do is that we take 4.3 multiplied by 2 million. 4.3 multiplied by 2 million bushel. That is 8.6 million that we do. Now, but on September 5, if the spot price of corn is 4.30, Growing and Financial LLC settle the contract without either party owing the other anything. But it is not possible, or let's assume the spot price of corn was 5 naira at September 5. It has changed to 5 naira. So the grown party that agreed to sell the contract to Financial LLC is making what? Is making a loss. And what happened to that loss? The loss is generated by what? By removing $4.3 from 5 naira, which makes it to become $0.7. So $0.7 is the loss multiplied by 2,000 barrels, which gives $1,400,000. What we are saying is this: the party that agrees to sell the asset, when the price of that asset at expiration increases, that party has lost. So Greenwich Incorporation that sell the forward contract, what it means that it will deliver 2 million bushels of corn to Financial LLC at 4.30, but unfortunately for him, the price of the corn has increased to 5 naira. So he has no option. He needs to also to deliver 2,000 bushels to Financial LLC. So instead of selling the contract in the market, selling the corn in the market at 5 naira per bushel and make 10 million, he will not sell. He will be obliged to sell it at 4.30 to Financial LLC and just make $8,600,000. So the LLC can now take it to the market and sell it at rate of 5 naira and make 10 million. So difference between 8.6 million and 10 million is what? Is $1.4 million. That happen to be the gain NSC will make and the loss Greenwich will make. And that is a concept, that is what leads to the concept of zero-sum game. So a zero-sum game is that the gain of a party is the loss of another party. So 1.4 is the gain to Financial NSC and it is a loss to what? To Greenwich Company. But in the other side, another thing can happen. The spot price will be what? Now the opposite will be true if the spot price was 3.50 naira. Let's assume by September 5, the price becomes 3.50 naira. It means that Greenwich will sell something that worth 350 at 430. So difference between 350 and 430, that is what? 350, that is 430 minus 350. 350 and 430. That is what's the difference? I think that is 80 naira. So that is 80, sorry, 0.8. So if 0.8 is the gain, it means that Greenwich is making the gain of 0.8 multiplied by the number of bus which is 2 million. So the gain is now $1.6 million. So it will deliver the quantity, the asset that was $3.50 to LLC, and LLC has no choice. He has to pay the amount they have agreed on, which is $1.30, and the loss to him is $1,600,000 naira. So that is how it is. So sellers and buyers of commodity often use forward contract as a means to lock in the price in selling price for a seller and lock in the price in buying price for what? For the manufacturing cost for a buyer. So that is on that.